So in this portion of our video, we're going to talk about a financial plan, the numbers behind futures. This is not the trading plan, but we want you to make sure you have a good understanding of the numbers of futures. You can go to my website, blog.asinotraders.com, go to our YouTube channel, and there's plenty of videos on why you should be trading futures over stocks and options and the like. So we're not going to have that conversation right now about why you should be trading futures over another investment vehicle, but we are going to talk about how the numbers work and how to make sense of it all. So in order to do that, we're going to start down here at the bottom at the constants. And so in this scenario, we have $500 per contract. $500 per contract. And so you guys know, especially if you've been with me a while, that I have a relationship to get that down to $300. But we'll talk about that later. But most brokers out there offer what is called an intraday E-mini margin. They're allowing you to borrow of $500 per contract, except for my beloved Thinkorswim, which is like $6,000. But most brokers are going to give you a $500 cost per contract to make the trade. So you need $500 to make the trade. I'm using a nice round number of $10. That means in order to buy the one contract and then later sell it, it's going to cost you $10. So if it's a losing trade and you only have $500, you're going to be with $409 at the end. Now, there are plenty of brokers out there that will beat that $10 hand over fist, especially the more you trade, more than likely they're going to lower your commission rate. You just need to go ahead and give them a call and say, hey, I'm making 50 trades a month. Let's get that commission down. But again, for our example here, our spreadsheet, we want to use nice round numbers. Now, we're going to be talking about the Dow Jones E-mini. So in the Dow Jones E-mini, you get $5 per point. For every time the Dow Jones E-mini ticks up one, you make $5. If it ticks down, you lose $5. $5 up, $5 down. Either way, it's the same amount. So, cost per contract, $500. My commissions on the trade, $10 per contract. And for every contract I have, I make or lose $5. Here we have our return on investment, and this will make more sense as we get up to our actual example. But you can see how many points you need to make your result and what's your return on investment. And right now you can see it's not that good. Finally, we have things in here to help us come with all our numbers, commissions, how much you're investing, how much you should have in your account. Again, risk management, there's a lot of talk about there about how much money you should have in your account for each one contract. We're not having that conversation right now. I'm just using these nice round numbers because some people will trade with nothing in their accounts. So I'm just using a 2-to-1 relationship for right now. We'll talk about that later in the video. So you just started trading. You're ready to start trading futures. And let's just say you went out there and you found Joe Smith's newsletter, Jane Doe's hot indicator, whatever it is, and you're ready to start trading. However, because you're new to trading and you're following somebody else's indicator, you haven't raised your financial literacy, you haven't developed your own trading plan yet, you're only right 50% of the time. So in our scenario, we're going to trade 5 contracts 5 times a day. So because it's 5 contracts, what does that mean? That means our commissions are going to be $250, $10 for each time. So 5 times 5 is 25, times 10 is $250. And since we're trading, and that's because we're trading 5 times per day. So our commission is $250. We're risking $2,500 because it's 5 contracts. Now, in our example here, we're only going to do a 1-to-1 relationship. For every $100 that I risk, I want to make $100. Now, that's the risk-to-reward relationship. Again, we'll talk more about that when we get to capital management. But again, in this example, a 100 risk and a $100 target is a 1-to-1 relationship. It's a 1-to-1 risk-to-reward relationship. So I'm willing to risk $100 in order to make $100. So when this is all said and done, I'm actually losing money. I'm actually losing money because although I'm 50%, I made $250. My commissions actually cost more. Got to pay those commissions. So after we do some research, we spend some time working on our emotions, developing a trading plan. We're trading in the zone now, and now we're ready to say, you know what, out of these 5 trades, I think I can be right 60% of the time. And what does that do? We're still risking $100 to make $100, and that turns us over to a $250 profit per day. A $250 profit per day. Now, before you laugh at $250 per day, you should know that for a month, that's $5,000 a month. $5,000. There's 20 trade sessions in a day, so that's $5,000 traded in a month. I don't know how many out there, especially our new traders, especially people who maybe not trading, how many of you guys making $5,000 a month? Enough said. So, again, we still have our one-to-one relationship. We still have our commissions in there. We're right 3 out of the 5 times. We're now making $250 a day. In order to do that, with our 5 contracts, we need 20 points. We're not going to talk about how easy that is. It is pretty easy. But I don't want to, give you this golden nugget saying, you're going to make $250 a day. No. But again, in this example, if we're only right 60% of the times, that means 3 of our trades were positive and 2 of our trades were not. And so after all that, as long as we're up 20 points, we made $250. Okay? Now you're really, not only have you developed your trading system, you're really now, as I said before, in the zone. If you've really fine-tuned and have really learned the best entry for your trades, you've got your ticks down, and so now what you're going to do is you're going to say, I don't want a 1-to-1 relationship. I want a 2-to-1 relationship. So I'm going to go with a $200 profit target. For every $100 I risk, I want to make $200. I want to make $200. So when we do that, what happens? We're now at a profit of $1,750 per day. Because we're now with a longer target, we need 40 points at the end of the day, trading 5 contracts. And remember, we're still saying we're only right 60% of the time. So that means 3 trades were positive, 2 trades we're losing. And when that's done, we want to have 40 points on 5 contracts, and we want to have, you'll have a profit of $1,750 a day, a 33% return on investment. So again, we're not going to have conversations about 40 points, 20 points. That's for a conversation for another day. But what I want you to see is that as we raise our profit target, if we were to tweak the numbers and let's go to 65%, all these things work in your favor. You see, I lowered to 150. We're still making over $1,000 a day, which is over $20,000 a month. All conversation about why futures have great leverage, but keep in mind, leverage with great leverage profit comes leverage loss without the proper money management, capital management, position sizing, risk management system. Again, an example, we're talking about losing $100. So that's the numbers of it all. And I'll send me an email, and I'll be more than happy to send this to you so you can tweak it and come up with your own system. But I just want to make sure that everybody understands how the numbers work in futures before we actually get into actually develop our trading system.